All right. Well, with that, why don't we'll kick it off with some introductions. So I'll just go around clockwise on my screen. So Mateus, why don't you start off? Could you give us an introduction to yourself?
All right. So Emily King, thank you for hosting this webinar. We're very excited to participate in it. I'm Mateus Faria. I'm a mining engineer as background. I also I got a master's degree from KPI-COSMO Stochastic Mining Planning Laboratory. And then I joined KPI Mining Solutions, and I'm working here as a product and consulting manager, working hard to push stochastic mine planning to the mining industry.
Awesome. And Laura, how about you?
Yeah, so hi everyone, my name is Laura. I'm Brazilian. I did my bachelor in mining engineering as well, and in Belo, Brazil. And I did my master the same as Matheus did in McGill Cosmo Lab, which is our partner. And I've been working, it's going to be almost a year at KPI Mining Solutions as a mine planning consultant. And yeah, we have our everyday challenge on convincing people and showing the value of stochastic mine planning optimization.
I would assume you both probably have to start off most conversations with just a definition of what stochastic mine modeling or mine planning is, right? So actually, I should have kicked it off with that. Would one of you just explain what stochastic mine planning is for anybody who doesn't know and was just attracted to the happy path to increasing their NPV? What is stochastic mine planning?
All right. So stochastic mine planning means, even though this name sometimes feels like a strong name or hard to understand, but essentially it means under uncertainty or following a probabilistic approach. So the major difference between conventional and the stochastic mine planning approach is that instead of using a single model of the mineral deposits, a single resource model as we do conventionally, we are now using a set of statistical simulations. So we're treating our resources in a probabilistic fashion. So in this simulated resources can be simulations of grades, material types, lithologies, or any other attribute of interest, geological attribute of interest. But stochastic is not only associated with geological uncertainty. We have other sources of uncertainty that impacts the feasibility of a mining project. And then we can think about market uncertainty. So we have huge fluctuations in the commodity prices. And this the evolutions of the commodity prices can also be simulated and then integrated into the mine planning optimization process. So we're definitely treating all inputs that we assume as deterministic in the conventional mine planning framework. We're now treating them probabilistically because we can now input simulations that are modeling the uncertainty coming from just multiple sources. Of course, there are other sources that are harder to be modeled mathematically, and then we cannot deal with them. For instance, what is your probability of getting an environmental permit, right? This is very hard. There's no known mathematical model to model this probability. It is a source of uncertainty, but since it cannot be right now modeled mathematically or simulated to be even more specific, then we don't integrate that into the optimization process. But for any sources that we can simulate, we have enough data and we're confident about the simulation methods, then we can integrate now. And why do we use simulations? That's the point. Is because in a world that is very uncertain, we want to generate a much more risk resilient forecast, right, for the NPV, for instance, which is the title of this webinar. So we want to have a risk-resilient forecast coming from a schedule. We'd rather have a schedule that is based on multiple possibilities or multiple probabilities instead of blindly looking at a single input. I don't know if I
no, and I think
properly.
Yeah, no, I think that's a great explanation, that it's about the ability to risk mitigate by having all of these different inputs modeled, and therefore many more scenarios that you can plan against, right? And then optimize. And with that, like when we first started talking about what this allows you to do, I know I was blown away at the fact that it can help you increase the value of your NPV, or your net present value. And at Prospector, at least, we pay a lot of attention to that because we have a little NPV calculator built in for companies that have put out a life of mine plan. You can go and you can kind of use different assumptions with a nice simple sensitivity analysis to see how changing those assumptions impacts the net present value of that project. But I know a lot of folks who this may not be what they look at day to day. Could you explain a little bit what a net present value is and why it's important?
I guess Laura will explain that in more details during the presentation, but if I could anticipate a bit. Net present value is the industry standard metric for mining projects evaluation, right? So we're essentially talking about the cumulative discounted cash flows, right? So we're gonna, during the whole life of mine, we're gonna have the productions of ore, wastes, and our products. This will lead to the cash flows. However, there is a key component here, which is the time value of money. So the money we make today is more than the money we make, the cash flows we're gonna make in a couple of years from now. So we need to discount these cash flows over time, and then we accumulate all these discounted cash flows, and then it's kind of, we are bringing the future cash flows to the today's value, right? And in doing so, we can compare different projects because it's a very informed metric, because we're balancing different costs, different revenues coming from different entities in our value chain. But what is very important in order to maximize the NPV for a mining project is it's coming from the resources, but also it's coming from the schedule. The schedule is the main driver to maximize the NPV. And that's what we're proposing here. In order to have a happy path to increase the NPV, we need to tackle these two components: the resources, the way we're modeling the resources, and that's why we're encouraging the mining companies to treat the resources in a probabilistic fashion by modeling the mineral deposits using simulations. So we're tackling this part. But also we need very good optimizers that can understand this probabilistic model and lead to a schedule that would maximize your yearly cash flows. And once these are accumulated, so now we are maximizing the NPV. So the same mineral deposit, right?
Yeah.
If we have a better modeling or a bad, the same deposit, if we have a bad modeling, geological modeling, and if we have a very bad scheduling optimization, our NPV, even for the same deposit, our NPV will be lower. But now, if we are able to better model the resources we have in the ground, and if we are better in terms of optimizing this scheduler, the scheduling, which will ultimately lead to the cash flows we get from the mine, then we're maximizing NPV.
Yeah, so it's those twofold pieces. It's better modeling the resources, and if you don't have a resource yet, if a project doesn't have a defined resource, then you can't come up with a net present value. You couldn't use this technology, right? So you have to come in at that level as a minimum, or be defining your resource, correct? But then it's also adding in all of the scheduling and the financial components into that. Is that right?
Exactly. So now the financial components combined with all the restrictions we have in terms of extraction of materials we have in the ground, plus all the material flows we need to have all the way to generating the products. That's how the scheduling optimization is important.
Okay, so for folks that are in right now live who maybe are working on earlier stage projects, does that mean that they shouldn't pay attention to this until they get to that point, or is there value in understanding stochastic mine planning even at an earlier exploration stage?
So what we are noticing is the value delivered by the stochastic approach. The value is coming either for projects in very early stages, either for operating mines that are going towards the end of their life of mines. Why the value is being materialized across any level of maturity of the project is because the geological models are a function of the available data, right? So at the beginning, the very beginning of the exploration campaigns, we don't have enough data. But based on the data environment we have in that stage, we can generate better simulations, better models of the mineral deposits compared to the deterministic and estimated paradigm, right? If we are in the late stages of the mining project, we're going to have much more knowledge about about the geology and how the grades are distributed, especially. However, the simulations and the estimated models, they will also become more informed and improved, right? So it doesn't matter where we are, right? The value can be materialized. And it's also important to take into account that if we're talking about a greenfield project in very early stages, then we are much less constrained, right? So we can play with a lot of assumptions, and then this can have a huge impact in the NPV or the financial outcome of the mining project. On the other hand, once we are going towards the end of the life of mine, then we have a lot of infrastructure in places. We have already extracted a huge part of the mineral deposit, so we don't have a lot of flexibility. But still, the value will be there in terms of assessing the opportunity to extend a bit more the life of mine, to increase a bit more our reserves. So we're seeing value in any level of maturity of the mining projects.
Okay. Well, and before we switch over to the demo that Laura's going to show us, like what this actually looks like, you know, when we were all chatting about doing this webinar, we came up with the title of The Happy Path to increase your NPV. So who wants to explain why you guys articulate it that way? What is the happy path?
Laura, do you want to explain the happy path? Or
No, you go ahead and say why the happy path.
All right. The happy path is actually an expression I learned from UI and UX experts, right? Whenever we need to do a demo or show the major user flow across an app, then that's what we call a happy path. And here, what we want to demonstrate is how by following all these steps, starting from the simulations all the way to the probabilistic forecast we get in the end, this will be a happy path in order to have a better project evaluation. That's it.
I love it because, of course, you know, at Prospector, we have a lot of UX discussions, and I had never heard that term before. So folks can expect to hear me use that from now on, and I'm going to quote you on that, Matthias.
I'm still not that happy because I'm kind of nervous, but I think we're going to get there.
You're doing great. You're doing great. All right. So Laura, did you want to add anything, or you want to go ahead and pull it up and kind of show us what we're talking about?
We have some points here before we move to the actual demo. I can go quickly on them and then go directly to the demo if that makes sense. So that's just a quick recap on what Matheus just said regarding NPVs. I don't need to go into details on that. I think he made a very good explanation to us. Some points that we can mention again. So NPV will account for time value of money, and that's very important because we're dealing with mining projects. It's not going to be 1 or 2 years. It's going to be 10, 20, even more periods. And that's very important to account for time value of money. We're balancing. So by having that, we can balance short-term versus long-term. We can understand how it will look like in more early periods versus in the long term. We can also include and have a weighting between CAPEX, OPEX, and the revenues that are directly, we can include all of that in our NPV evaluation. We can acknowledge bottlenecks. So as Mateus mentioned, that's very interesting for early stages projects where you don't have exactly defined bottlenecks such as mining capacity, not even mill capacity sometimes. So by optimizing the NPV directly, you can understand and balance on the capex versus the capacities that you wanna have in your project and have a better and more optimal decisions. And it's more informative financial metric than other metrics that we might have. So overall, what we understand is that we want to maximize our NPV because that's the best way to evaluate the shareholder value. So the whole value of your entire project in a whole. So what we do with conventional mine planning, I guess most of the people that might be in this joining our talk will understand very well how it works. We started with the estimated model, and then we have different softwares or different tools or packages to do each of these steps. So we start with the pit limit, then we define phases. Based on the phases, the extraction sequence, then cutoff, then some stockpiling decisions, processing stream decisions, and sometimes transportation options. And the problem is that the first thing that we already said, the just having an estimated model does not assess or show your uncertainty and geological variability. And what is very important to note is that even if you have a greenfield project, or you say, oh no, I have a super well-informed drilling campaign, I don't have uncertainty. You do have uncertainty. You will never know exactly what you have underground. So you always have uncertainty, and you have to assess and manage this uncertainty. And more important, like more related to the topic we're talking today about NPVs, we have two first steps. So defining the ultimate pit limit and defining phases is not based on NPV. It's usually based on undiscounted cash flows and some other not mathematical decisions, like more user decisions. And then we just account on NPV when we are gonna define the extraction sequence. So we are creating a restriction here, a constraint here for our next step. And we only look at NPV on the extraction sequence. So as you can see, we're not actually looking for a guaranteed optimal NPV at the end of the day. And again, we know by many studies that this is an example in Australasian mining projects that 80% of the projects might fail due to geological risk. And when we do some risk analysis related to it, we see that, and we see that in our projects that usually when we look at a single NPV forecast, when we look at the probability of this forecast actually happening, we see that usually we have only 2 to 4% probability of it happening. So it's very low. Most likely we won't have that high NPV. So again, we have to capitalize on the uncertainty.
Laura, are you saying that companies might be promoting an NPV that is only 2 to 4% likely to happen?
Say again, who is promoting that?
Well, the companies, the NPV that they speak to, oftentimes only has a 4% probability. This is why it's important for investors to understand this, right? as well.
Yes.
Yeah.
So if you just have a deterministic or a conventional or a single representation of what you're looking at, you're going to have one curve. So you will not even know this probability, right? But if you have a way to map this probability, then yes, the answer is yes. Maybe there are many projects that are advertising an NPV, and then there's only 2 to 4% to happen.
When I ask that because I think it's important as people are thinking about investing in something like this, right? It's important to understand what, it gives you a lot of value back, and that you have a higher level of certainty for your shareholders as to the value of the project that you're leading.
Absolutely. Having a better mapping of uncertainty gives us a better idea on the risk of investing in that project. And that's very interesting for investors. Absolutely.
Another important point, imagine that you are comparing, as an investor, you're comparing two projects, right? And apparently they have a same forecast of NPV. Right now, we should be able not to compare these two projects based on this forecast, but we should be able to make a decision based on what is the potential variance of this value, right? Given all the sources of uncertainty we discussed previously, would you rather invest on a project in which this range is much shorter, the variance of this NPV is much shorter, or on a project that this variance is much higher, right? So this is a challenge that the investors are having right now, because we cannot foresee what is the risk associated with the forecasts that are being published, right? So that's what we're encouraging the companies. Let's use stochastic or the stochastic approach in order to assess the risk associated with any reports.
So how do we do it differently? So we start from a set of simulated block models from the mineral deposit. We can have other sources of uncertainty, example price uncertainty, and give that as input to our optimizer that will simultaneously optimize all the components that we need for a mine plan. So we are going to directly optimize the extraction sequence that will drive us to optimal pit limits. At the same time, the cutoff grades and destination policies, therefore stockpiling, processing and blending streams, and also transportation modes options. And that can lead us to up to 40% higher NPV. This is what we've seen, but we tend to have a higher NPV when we compare our stochastic forecast to the risk that we see, the risk profiles that we see in the deterministic forecast, because we're able to capitalize on that uncertainty instead of just ignoring it and then looking at it, and also because we're doing this simultaneous optimization. So
That's
this is the same thing
huge
instead.
potential.
It's a huge potential, and we have to capitalize on that and not just ignore it. So that's what I said in terms of NPVs. In terms of targets, we managed to satisfy our targets by looking at all the possible scenarios. So all the by looking at the risk and minimizing the risk of deviating of our targets, we tend to have a better use of our economic reserves, because we're not constrained by a defined pit limit or pushback. We're optimizing that altogether. And also in terms of sustainability, which is very important nowadays. We cannot just mine whatever and try to reach the ore and by any cost and not thinking about the environment. What we see is that by doing that all simultaneously, we can reduce the waste production as well, for instance. So now I'm gonna move to the actual happy path. So to the software, so as I mentioned, we start with the input of our body simulations. So as you can see here, I'm showing one simulation. You're gonna see an example that we have 2 mines. So we will have to have simulations for each mine. So as you can see here, I'm showing a simulation 4 in terms of copper grade. And if you look, I don't know, simulation 9 for copper grade, we're gonna see that they look slightly different. And if we move on, we're gonna see a different from one simulation from another. And what is important to understand is that, okay, they look different. There is not a simulation that is right or wrong, one simulation that is better than the other. They're all done, they're all modeled in a sense that we can reproduce in the best way we can what is in the ground, but also in a probabilistic way. So when we look at all of them together, we can assess the uncertainty. And by giving the input of these simulated models to the software, we want to get here. We want to get to a single extraction sequence for each mine. So you're going to understand it's a bit hard in the beginning. How do you get 20 simulations and you get to one extraction sequence at the end? You're going to understand. But that's what we want. We don't want to have a bunch of extraction sequence, because then you don't know how to make a decision. Where do I mine? When do I mine? You have to have a single decision, right? Where am I going to mine and when? And we generate our forecasts. So here we have the forecast for mining tonnage. And you might be thinking, okay, why you have only a single curve on this example? I was expecting that bunch of curves. So in this case, we only simulated the copper grades. We didn't simulate volumes, boundaries, tonnages, or anything that will impact directly on the block tonnage. We can add that type of uncertainty as well, but in this case, we haven't. So since we don't simulate the tonnages in this example, and we have a single extraction sequence, all the scenario, all the curves that represent each scenario, they will overlap each other. So this is why I have overlapping curves for the mining tonnage for both mines. But when we look at other forecasts, such as the cash flow, the head grade, in this case in the mill, or in the leach pad, or even the feed mass of the mill, we see many curves. So in the cash flow, for instance, I will have 400 curves, which is 20 times 20, 20 for each mine in this case. And by looking at it, we can assess the risk in each period. And what we can do in the software, just to show you how it works, we can accumulate this cash flow. So we're going to have our NPV. And we usually look at this forecast by looking at different percentiles. So P10, P50, and P90.
Laura, do you always do 20 per mine? Is that like the standard, or is that something that's determined by a different question or something the client wants?
That's a pretty good question. So we have a number based on studies, which is 15 to 20 simulations are enough. That will be for each mine to give us stable solutions in terms of the optimization. Yeah, so this is why in this case we're using 20. So coming back to the percentile. So the idea is that the P50 will be something close to what would be the expected, in this case, NPV. And the P10, P90 will give us an 80% confidence interval. So we can have a more clear view in terms of how to look at this uncertainty.
And that's when you're saying the P90, I mean, that's the probability of that curve occurring, right? Is what that means. And it's
Yes, it means in this case that 90% of the curves, the colorful curves, would be below this green curve.
Okay.
The same for P10. It means that 10% of the scenario curves will be below this curve. So here we have 80%.
I never took statistics, so just clarify.
That's how it works. And we can do the same for other profiles, and by looking at them, we can understand the risk. So for instance, we have periods which the curves are more spread out, and that might indicate that we have higher risk on these periods in terms of grades and so on. Now moving to what do we do in the software to get to this point, to get to this result. So we have this workflow. So we start with the inputs, then we build our value chain, we define targets, then we move to defining mineability or operational constraints, we define our objective function, and then we move more to the background, to what is done in the solver. So in terms of the data set, so as I mentioned, we have 2 mines. And what is the minimum requirement that we have here is to input a set of simulations for each mine, block model, simulated block model. So in this case, we have 20, and at least one attribute. So attribute would be represented by these headers. At least one attribute here needs to be simulated. We have to have an uncertainty modeled in terms of at least of one attribute. In this case, it's copper grade. We'll have the same thing for mine 2, so 20 simulations. And in terms of geotechnical zones, we have to provide an input of what are the geotechnical zones, and then you're going to see that along with these geotechnical zones, we're going to define the slope angles, and we cannot have simulated geotechnical zones, for instance, because we want one extraction sequence. So there will be no way to have variable geotechnical zones, and at the end of the day, just get one extraction sequence. So that's the principle that we have here to define our inputs. And as you can see here, we can have other type of inputs as lookup tables. We have copper recovery curves, and there are many more other inputs that you can give to the software that you can use then in your value chain. So then the idea is to build a value chain that will replicate the flow of material in your actual mineral value chain. So in your mining complex. So we can do that also in terms of, let me put it in the screen that is already centralized. So the idea here is to define the materials that you will have and the flow of materials from the mines to the processing streams or to the stockpile and so on. And what we want is to optimize the extraction sequence of these mines and all this flow of material all together in one shot. So as you can see here, there is waste.
So is this built off of like a flow sheet then, basically, or did somebody build this out in order to create like a flow sheet for their process?
Yes. We built everything within the software. So you're literally gonna add, for instance, here we have already this, but you can add a destination, and you're gonna name this destination, and then you're gonna create all these links in the way you want. You can customize it to replicate the flow of material that you wanna have.
My destination will be Brazil.
We should optimize that, your trip to Brazil. The locations and when you're going to go. It's going to be perfect.
Travel dates.
We should try. We should try.
see if it works.
Maybe. So within these materials that we're creating and linking to the destinations and sources, we're going to define some attributes. So the attributes basically are everything that you want to report. So as I've shown before, the cash flow, the copper head grade in the processor, the profit, and the copper content that is recovered on that location, everything that you're gonna see in your forecast, in your graphs, they are modeled as attributes within each location and within each material that we define. Okay. But then we have one more thing. So we have attributes for each location, each material, but we also have what we call global attributes. In this case, is the cash flow, which basically will incorporate all the profits and all the costs from all the locations. And what is interesting to see is that we have a very flexible way on doing that. So as you can see, we can define these attributes based on expressions, by summing attributes from other locations, by getting them from lookup tables, such as we do for recoveries. So you basically can create, and you have infinite possibilities on how to mine your, how to model your mineral value chain in this tab. The next step will be defining your targets. So as all mining projects, we usually have a mining capacity, the capacity of your processor, everything that you want to add as a constraint, you're going to add in this tab, and you can customize. It can be variable in each period. You can unselect, select, change these values, and do it in the way you want.
Laura, real quick,
Then,
a question. What about if
sure.
if the person doing this is, if they're working on a much earlier stage project where they don't even have those to set yet? Is that what you meant by, you could be really flexible with an early stage project because you're not restricted by any of those?
Absolutely. So basically, you start with no targets. You're not obliged to have any targets. So you can start very flexible with no targets at all. You're gonna have to have at least one as mining tonnage, for instance, or you're gonna mine everything in the first period. But you can start very flexible, and then adding more constraints in order to have something more operational, and then update that when you have more information. But yeah, you can start very flexible and then just see what you get from it and work based on your forecast and refine it in as later processes.
Okay.
The definition of a capacities, right, is a major component of this feasibility studies of a greenfield project, right? So we're just finishing a project right now that we concluded that we should downsize the processing plants because we were optimizing for higher capacities, and we saw that the processing plants was underutilized, and then we played with that. So we can have a for the early stage projects, we can. That's where we have a lot of flexibility to defining a proper mining rate and processing rate for the whole project.
Okay. And I should have asked you guys to clarify too, for folks that are watching, like when they're watching you go through this, Laura, is this something that they do, or is this something that you all help them do, like go through this process? Do they have to learn how to do this themselves?
They don't have to. If they want to, they can learn. We can provide a training and guiding, and if they have a license, for instance, they will always be helped. They will always have assistance, but my job is actually I'm a consultant, so we can do that for you and be right next to our clients, building it for them and giving a more direct assistant for specific projects.
Okay. Especially if they do have an earlier stage project, maybe they don't have a team that does this every day, right? Yeah. Okay. Sorry, I got interrupted.
No, that was a good question. Yeah, we have a team, and we can definitely help anyone that doesn't have the team to do this work. Then we move to mineability constraints, which the minimum mineability constraint that we're gonna have here is the slope angles, but then you will be you can add and play with that as well. The operational constraints such as mining width, sink rates, and so on. And that's gonna be for each mine. Finally, we're gonna get to our objective function. If a question comes up later, I will go into more details in this part, but right now we need to understand that we have basically two major components for the objective function. The first component is the NPV maximization. Sorry. So this is why we defined a global attribute, which is the cash flow, to be the goal of our optimization process. And what we want to do is to maximize this cash flow based on a discount rate, obviously, so we can get the maximum profit, the maximum value of your mining project, as we discussed a lot today. And the second component, we call it risk management. So basically, as you saw earlier, we have probabilistic forecast. So we have a bunch of curves and representing the scenarios, right? So, and we define the targets. However, for instance, for mining tonnage is going to be a bit different for this one. But let's say you have a target for the copper head grade. There is no way for you to get all those curves and match exactly that target or match exactly the upper bound or lower bound because you have uncertainty, or it's going to be very hard to. So that's why we have this component. What we want to do is to minimize the deviation from these curves to your target. And to do that, we have a discount rate, which works similarly as an economic discount rate, and a penalty cost. So this penalty cost will literally penalize more or less this deviation in a sense that you want to minimize it, while the discount rate is going to be applied to this penalty cost, just as an economic discount rate. And the idea of that is that you want to, let's say, delay the risk. So especially for early projects, it's better if you leave the risk of getting to more uncertain areas to later periods than right now, because up until you get to your 20th year, you still have more time to work on your drilling campaigns and to have more information regarding your ore body and your forecasts. So that's the idea of having a discount rate here. So for all these constraints or targets that we added in this component, as much as you penalize, the less you tend to deviate from this target. And the idea is to balance these penalties so that you can have a trade-off between maximizing NPVs and managing the risk. And what is very interesting here is that, especially if you don't have an exact definition of your capacities, you can play with these penalties and start from a low penalty and see what you get from it. And so you can understand better if you're going towards the right direction in terms of the bottlenecks you're defining for your project. Okay, so we're getting close to the end. So in terms of the decisions, this is more on the background, but the idea is that we have the extraction sequence decision that will define our extraction sequence. We have our destination policy that will define the flow from your mine to your processing streams, and then to your initial destinations, and then the processing stream decisions that will define the flow from the stockpile to other destinations. And the most important thing to look here is how we define this destination policy. So the idea is that we're basically optimizing all of this together, and here we are defining how we're gonna optimize our cutoff all simultaneously. So as you can see, we're gonna have a definition of cutoff for each material that we have on the mine. So here waste, oxides, and sulfides, and we're gonna see it just like that. So we're gonna have a variable cutoff grade policy that is optimized with the extraction sequence. So defining what is the cutoff between waste and the material that goes to the mill, and waste and stockpile and mill, and so on. And you're gonna have a single cutoff policy for each material that you have on the mine. Okay, we're here. And then finally we get to the solver part, which is basically you're gonna press to run the solver, and all of these components, all of these parts that we have defined here, they're gonna be optimized in one shot, and you're gonna get the results that I've shown you in the very beginning of this demo. So that is the happy path to higher NPVs.
Awesome. Thank you, Laura. Really appreciate that. And we've got a few minutes left for questions. So if anybody's got any questions they want to throw in on LinkedIn, we'll see how many we can get to. We've got one question from Augusto. In the case of a multivariate deposit, do you have an equivalent model based on the principal variable?
That's if I may answer, that's the beauty of just statistical simulations, right? We have very robust simulation methods to simulate multiple correlated variables, right? So essentially, there are the correlation methods. So imagine that you have copper and gold that are correlated. So there are decorrelation methods. So we can decorrelate this two grades. Then they are simulated independently. And then once we have the independent simulations, we correlate back. So as a result, the simulations will reproduce these spatial correlations we see in the exploration data. So the simulations will reproduce this geological pattern. And then in our software, we're able now to model the metal content coming from each block, like simulated metal content coming from each block. We can keep track of these two grades separately. Also, our cutoff grade policy that traditionally we're looking to a single grade, we can select different multiple grades to define the best destination of a block if we are in a multivariate deposit. Or even needed, we can also work with equivalent grades, but the equivalent grades will be calculated based on grades that were simulated separately, even though they're maintaining the spatial correlation. So it's very flexible. And this is one of the biggest advantages we have in the simulation methods that is quite hard on the estimation side, right, on the kriging side, because then we would need to do co-kriging or other methods that are quite cumbersome to be modeled. In the simulations, we have a very robust and easy workflow to generate multiple grades, simulations of multiple grades.
Okay, we've got another question. In the case of multi-pit projects with different restrictions for each pit, is the optimization carried out together to see the global mining sequence and when to start each pit, or is it carried out separately?
So basically, the example I was showing. We have two pits. We're optimizing everything together. However, you're gonna have one sequence for each pit.
Mm-hmm.
So the optimization is done together. The starting period of, for instance, one pit will take into account the decisions made for the other pit and vice versa. But at the end, we're going to provide one extraction sequence for each, and you can define one target for each pit and so on.
Okay.
But ultimately, the optimizer may decide to start extracting only from one pit and leaving the other aside, right? So the optimization process will define the optimal startup and shutdown of each mine. Of course, in the real world, we may be constrained by permits, right? So we can also adjust in the software some eligible periods that this mine could start given the permits or restrictions.
Or areas.
Yeah, and on that then, so when you come into the real world scenario, if you then have these constraints like permits, they can go back and look at those other scenarios then, right? And see, okay, this is more closely corresponding to a suboptimal scenario, and therefore here's what we can expect as well, correct? You can even model out your real life scenarios by looking at it that way.
Exactly. So we have an unconstrained scenario. That's your upper bound in terms of value. But then we can assess different scenarios of where this constraints will take place. And then we assess the loss, the value loss we're having just by just coming from these restrictions that are being imposed.
So in that sense, is this a tool then that the companies would continue to use throughout the life cycle of the project? You come back and rerun the scenarios based off of changes in what's going on in real life on the ground?
Go ahead.
Yeah, it's a strategic planning software, so we're doing long-term plan. That's important to mention. However, it's always important to review the plan, especially when you have more informed inputs, and once you have actually started mining. So you can always use that to update your long-term plan. But it's very nice to start with that, not leave to the future. Just start with that, so you're gonna have a more risk resilient initial plan, and then you know what to expect in the future.
All right, any other questions, please drop them in. We've got about 2 minutes left on the live stream if anybody has any questions or comments. And then also this whole recording will stay up on LinkedIn Live, or it won't be live anymore, of course, but you can go back and rewatch it or share it with anybody, and we'll also follow up with the folks that accepted. And if you have any questions, you can, of course, reach out to us at Prospector or Laura and Mateus at KPI as well. And it looks like Jess threw up the website there as well on the scroll bar. But we'll hang on a few more minutes if anybody has any more questions.